Hi guys, welcome back for yet another theory session. And today we'll be diving into a very fascinating and less discussed area, which is Islamic finance instruments. Now, when people hear Islamic finance, they assume it's only for Muslim investors or for countries, where Islam is the dominant religion. But that's a misconception. Islamic finance is about ethics, it's about being fair, and it's about real economic activity. And that's something any responsible investor will relate to, must relate to. By the end of this session, you will understand how instruments like Murbaha, Ijara, Sukuk, Mudarba, how do they work, how they differ from conventional tools, and how they actually show up in the real world. Now, let's start with an understanding of what are Islamic finance instruments and what is the background and the mode of operation of these instruments. Let's start with the why. See, Islamic finance is not a niche anymore, it's massive. Globally, we are talking about roughly $1.6 trillion plus in assets. Governments use it to fund airports and highways, corporates use it for equipment finance, and investors love it because it's ethical and asset backed. I mean, Malaysia today is one of the biggest sukuk markets in the world. And so, if you're studying for ACCA AFM or even SBL for that matter, this isn't just theory, it's a part of the financial landscape that you will actually work in. Now, what are some of the core principles of Islamic finance? Islamic finance is based on certain principles of fairness, as one would say. It rests on four pillars. There is no riba, that is, there is no interest. Money shouldn't earn money, but it should be generated from real economic activity. There should be no excessive, so there should be no speculation, no gambling or speculation. You should not participate in any activity which is banned under Islam. Like, you should not, the money should not go into processing pork, or it should not go into alcohol, or it should not go into gambling, some of these areas. And of course, there should be no gharad, which means no excessive uncertainty or ambiguity. Now, there are quite a few basic Islamic finance instruments. We'll see them one by one. And to see the difference between the two, how is Islamic finance different from your conventional banking? In conventional banking, you lend money and you earn interest. In Islamic finance, you buy or invest in an asset and you earn profit from that asset. So it's not about lending for the sake of lending, it's about participating in real trade. So when we look at a murbaha or ijra, remember that the principle isn't borrow and pay back with interest, it's buy, use, or sell something of real value. Now, the key instruments that we'll be studying are your Murbaha, which is trade credit. It is trade. It's like, how you have a relationship with your creditors. Murbaha is like that. Then Ijra is like lease finance. We'll have separate slides and discussions for each one of these. Sukuk is basically your Islamic bonds. Then you have Mudarba, which is like equity finance, and Musharka, which is like venture capital. There are also forward contracts like Salam and Istisna, which have features similar to an advance purchase or a forward agreement, but there are certain differences also involved. This is just a summary of those instruments. We are going to dive deeper into each one of these. Now, what are some of the advantages of Islamic finance? It is ethical and fair because it is based on the principles of mutual benefit, fairness, and trust, and it discourages exploitation. So, to put certain things straightforward, Islamic finance is based on certain noble principles that the money should not be channeled into unethical activities. The money should not earn money, but money should be generated through real economic activity. So excessive interest, or even interest for that matter, is not allowed under Islamic finance. It is community oriented, focuses on real economic activity and wider benefits to the society, promotes long term stability, and there is resilience in crisis. Islamic finance avoids high risk structures like excessive leverage, potentially reducing the financial crisis impact. It gives you access to There's global access to capital because, as I told you, South Malaysia is one of the biggest sukuk markets. Dubai is also, one of the bigger markets out there. Plus, even to non-Muslim investors who believe in ethical investing, even they will be drawn to Sharia compliant finance because the principles are based on fairness and ethics. However, there are certain limitations as well. The Due to Sharia compliance and legal complexities, product development and approval are slower, not like how it happens in today's fintech world where products are getting approved in minutes, and that also feels like a challenge to me. Higher costs because of due diligence, legal reviews, and approval layers, which increase the cost for the Islamic finance instruments. There is limited flexibility. They can't react quickly to market demands or speculative opportunities. There are agency issues that we have discussed earlier in different topics in SBL and AAA, because so the similar agency issues will impact your instruments like Musharka, which is an equity based instrument. So the challenges that you have in case of equity shareholders and managers or management who run the business. Equity shareholders are the owners of the company, but managers run the business on their behalf. So that can lead to conflict and tension between managers and the shareholders. Similar thing can happen in instruments like Musharka, which are equity based instruments. Some contracts may not get debt like tax benefits, raising the cost of capital. So, traditional debt gets tax benefits. Some Islamic finance instruments might not get that. And there could be product criticism that some products mimic conventional instruments too closely, raising Sharia compliance concerns. So, in very strict economies, that might not be allowed as an alternative. Sharia interpretations vary by region, affecting product acceptance and global compatibility. And Islamic products maybe more expensive or less adaptable compared to conventional finance options. So, if a question with respect to this comes in the exam, you should know that these are the eight limitations and you should specifically focus on these. Now, let's go instrument wise. Okay, what is a murbaha? Let's try to understand. So, how does this instrument work? Now, think of Murbaha as a cost plus sale. Instead of giving you a loan, the bank buys the item that you want. Say it buys a machine, it sells it to you at a markup, and over time, you pay that amount along with the markup. That markup is the bank's profit. It is straightforward, transparent, and completely Sharia compliant. Now, how does Murbaha work? We discussed that the bank will buy the asset on your behalf and it will take the ownership of the asset, sell it to you at a markup price. So the bank buys it for 10,000, it adds a markup 12,000, it sells the asset to you for 12,000 and you pay in installments. So it's not like the bank is giving you loan to buy a laptop. The bank is buying the laptop for you, adding its markup and then recovering the amount from you. Now, how is it different from a conventional loan? Okay, so in a loan, the bank gives you money and charges interest. In Murbaha, the bank gives you an asset and charges a profit disclosed upfront. Another big difference is penalties. In a conventional loan, late fees will definitely apply. Whereas in case of Murbaha, no additional charges are allowed. There is early payment discount often allowed or encouraged. In Murbaha, it is not contractual, it is optional, it's not compulsory. In a conventional loan, interest applies. In a Murbaha, there is no interest, there is only pre-agreed profit. Okay, you receive the money in a loan and then you use that money to buy the asset. Here, you directly receive an asset. Um, See, the ownership risk is with the bank. The bank owns the asset first. The profit is disclosed upfront. There is no specific interest, but the markup is added to the cost of the asset and the amount is recovered from you. Now, the good part is that it is Sharia compliant. The bank takes the risk and the disclosure of profit is upfront, which makes it transparent. It can be used for any different purposes and different types of assets. Plus, it is an ethical instrument. There are no penalties for delayed payment and it promotes ethical finance. A bank buys a machinery for 1 lakh, adds a markup, sells it to you for 1,10,000 and it recovers 1,10,000 maybe in 10 monthly installments. Not charging interest is one of the core principles at the heart of Islamic finance, and this instrument follows that to the letter. Now, when Emirates Airlines, needed aircraft parts, Dubai Islamic Bank used Murbaha. They bought the components first, sold them to the airline at a declared profit with deferred payment. Everyone knew the markup, everyone agreed on timing, and the deal was 100% Sharia compliant. It's a simple instrument which replaces complex interest structures. And with understanding Murbaha, let's move on to the next one, which is Ijra. Ijra is the Islamic finance equivalent of leasing. It allows a business to use an asset without owning it in exchange for paying rent. So the concept is that you use the asset, but the bank owns the asset. Okay, in the earlier one, the bank purchased the asset and bank sold the asset to you. Okay, the bank sold the asset to you and then it recovered the money from you in installments. Ijra is built on a simple idea. You use it, bank owns it. Instead of borrowing money to buy a car or a piece of machinery, the bank buys the car for you and it leases out to you. So you pay a fixed rental. You don't pay you don't pay installments like you would pay in a loan, but you pay rentals. So the ownership remains with the bank. Okay, say I want to buy a fleet of trucks, the bank will purchase those trucks for me, then it will lease them to me for an agreed rent and time period. And at the end, the customer either returns the fleet of trucks, renews the lease, or buys them at whatever is the fair value. And throughout this entire duration, bank is the owner, which means bank pays for the repairs, insurance, while the client just keeps on using the item and he keeps on paying the agreed lease rental. Now imagine an Indian logistics company that needs a fleet of, 5,000 delivery vans. Now instead of taking a term loan, it signs an Ijara deal. The bank buys these vans, it leases them out at 20,000 a month for, 5 years. The company gets its vans without locking the capital. Had the company purchased that entire set of delivery vans, it would have to make like a huge capital investment and funds would have become blocked. Here, that is not the case. You are paying in installments every month for the next 5 years. So free cash flow remains with the company and the bank earns a legitimate rental income also, and at the end you might buy it or you might just return it. Some of the key features or key conditions of an Ijara contract is that the purpose and usage of the asset must be clearly stated, full transparency. The bank remains the owner. It is the bank's responsibility to pay for major maintenance and ownership because they are the owners, whereas your responsibility is to maintain the asset in good working condition, the operational upkeep. Now, what is the difference between Ijara versus a conventional lease? So, in case of Ijra, the ownership of the asset stays with the bank, whereas in a conventional lease, it passes on to the lessor or can transfer to the lessor at the end of the term. The payments are there is fixed rent payment. In a conventional lease, there are regular lease payments which might include a finance charge element, which is not there in case of Ijra. Then maintenance of the asset, major maintenance is the bank's responsibility. Here it is the lessee's responsibility in a conventional lease. Transfer of asset is optional at the end of the lease term. In a conventional lease, you will find that happening in most cases. And by the way, to quote a real life situation, Etihad Airways financed a part of its aircraft fleet through Ijra. The bank bought the planes. Etihad leased them, and the rentals came from flight operations. So the financing stayed Sharia compliant, no interest, just asset based rental. Okay. And as a couple of principles which are at the very heart of Islamic finance, no interest, that is riba, asset backed finance, focused on not money lending as the primary feature, but helping or fostering real economic activity. So that is why the instrument also remains Sharia compliant. Let's now talk about Sukuk, which probably could be one of the fastest growing instruments in the bond market. Okay, these are Islamic finance bonds, one of the most powerful tools in Islamic finance, and people often call them Islamic bonds, which is not entirely accurate. When you buy a sukuk, you are not lending money, you are actually buying a share of a real asset or a project. Your return comes from that asset's income, rent, profit, or service revenue, not from interest. Okay, so how does Sukuk work? You identify an asset, maybe an airport, a toll road project, or a solar energy generation project. Investors buy Sukuk certificates linked to that asset. The project earns income, the highway, the airport, the toll road, whatever, it earns income in the form of lease rentals and or toll fees, and that income is distributed as returns to Sukuk holders. And yes, investors also share in the risk. So if the revenue drops, the returns drop too. And that is genuine risk sharing, something that conventional bonds will not offer to you. Okay, there are two types of sukuk instruments. One is government, so asset backed, and the other one is asset based. Let's understand the difference between the two. In the asset based sukuk, the asset itself is used as the collateral. Returns are linked to the company's performance. Okay. In an asset backed sukuk, the investors own the asset directly and returns come directly from the asset generated income. Okay. Here, in case of an asset based sukuk, returns are linked to the company's overall performance. Okay. In a real example from Malaysia that I have heard of, see the government, for example, it built a toll highway through Sukuk funding. Investors earned returns from toll collections, and when the traffic dipped, the returns dipped too. That is asset backed. Investors own the asset directly, and the returns they get are from the income generated from that particular asset. Similarly, in India, we have seen similar structures for infrastructure special purpose vehicles, though they are not always labeled sukuk. This concept works anywhere where real assets generate real income and the income is tied back to the asset itself. The basic idea of Islamic finance of no interest, of asset backed returns, and fostering real economic growth are basically all followed in this specific instrument. In Sukuk, there is ownership in assets. In conventional bonds, you give loan to the issuer. In case of Sukuk, the income is from the income generated from the performance of the asset. In case of conventional bonds, it is in the form of interest payment. Okay, there is no interest in case of sukuk because it is prohibited under Sharia. Interest is the main return under conventional bonds. There is, so in the conventional bonds, the original principal capital is guaranteed. It may or may not be guaranteed in the Islamic finance version, which is the sukuk bonds. Then ownership, there is partial ownership in real assets. In case of conventional bonds, there is no asset ownership. It is purely financial. And there is risk sharing in case of sukuk because, with the Malaysian highway example, if the income drops from that asset, then your returns also drop. That is not the case in case of conventional bonds. So sukuk holders don't get voting rights. And of course, there is no interest. But what they do get is they get profit rights before shareholders. This may include security, but only over real assets, and profit or loss depends upon the performance of the assets. Okay. Again, the same features, the fact that there is no interest, there is ethical financing, real assets are generating income, not speculative contracts, and there is risk sharing, makes the instrument Sharia law compliant. Let's move into, something a little more interesting, which is salam. Okay, now what are these salam contracts? It is a forward sale. The buyer pays in full today and the seller delivers the goods later. It is one of the oldest Islamic financing methods designed specially to help farmers and small producers who need cash in advance. The buyer pays in full today, so a middleman or a supermarket will purchase it today and he will pay you today, but the goods are to be delivered later. The key word here is pay now, receive later. But the trick is everything quality, quantity, delivery date, and location must be agreed upon right at the start. Okay. Now, how does a salam contract work? A farmer agrees to sell 100 tons of wheat to a bank deliverable after harvest. The bank pays him the full amount today, say 20 lakh rupees. When the wheat is ready, 6 months later, the farmer delivers it to the bank. The bank can then sell it to a miller or a trader, maybe at a higher price, through a parallel salam contract. Okay. And the farmer gets the money in advance It's like an advance funding without taking a loan, and the bank earns profits from the real trade, not interest. Now, salam is used heavily in agriculture and commodity trade across countries like Pakistan, Sudan, and parts of the Middle East. Even in India, you can think of sugar mills or cooperative societies paying farmers upfront for cane or grains, and the logic is similar. The goal is to inject liquidity earlier and, not causing speculation later. Now, what is the difference between a salam contract and a regular forward contract? Here, the amount is 100% paid in advance at the inception. That is not the case in for a regular forward contract. There is no interest involved in a forward contract. It is often priced with time value. Here, you only deal with real assets, real goods in salam, no gold, silver currency. In forward contract, you can have a forward contract for anything. The buyer assumes the delivery risk. In a forward contract, the delivery risk is shared. Salam is not speculative in nature, but forward contracts are often used for speculation. Okay. Now, we all know, like, if Salam is a forward, is a variant of a forward contract for items that already are growing or exist, like crops, for example. Istisna is for things that are built or manufactured. So Salam is for probably naturally occurring things more, like crops specifically. But Istisna is another form of a forward contract, which is mostly for items that are built or manufactured. Think of it as Islamic project finance for the construction or manufacturing world. Build now and pay gradually. So, how does the contract work? A company needs a custom built machine. It approaches an Islamic bank for financing. The bank signs an istisna with the company, agreeing to deliver that machine once it's built. The bank in turn hires a manufacturer under a parallel istisna to actually make it. The company pays the bank in milestones, say 20% advance, 40% midway, 40% on completion. There is no interest, just a cost plus markup when the final product is delivered. Okay, it is most commonly used for infra projects, industrial machinery, real estate development. The payment terms are flexible, they have to be mutually agreed upon. There is no fixed delivery date. Payment happens, on the completion of milestones, and parallel contracts are possible. Bank outsources project to a builder while collecting from the client. Okay, and ownership passes to the client after delivery. Now, many infra projects, like airports, industrial plants, have been financed using Istisna because these are way longer, than your conventional instruments. An Islamic bank might fund a real estate project, pay the builder in phases, and sell completed units to the client at a profit. It is a Sharia compliant form of construction finance, ethical, asset backed, and milestone based. So it differs from a regular construction loan because it is built to order asset financed by the bank, whereas a regular construction loan is disbursed at the beginning for project funding. Istisna is customizable. Construction loan is often drawdown based, or it is often released after completion of certain milestones. A key feature of Islamic finance: no interest remains here, but in your regular loans, interest is charged. Asset ownership: bank or builder owns during construction. A construction loan, borrower owns under mortgage, and the delivery obligation is at completion. And in case of a construction loan, it is usually in a phased manner. Okay. Again, the same principles of no interest, real economic activity, ethical and transparent funding apply to istisna as well. Now let's transition to some partnership based finance instruments, one of which is Mudarba. It is, it's simple, it's fair, it's elegant. It's a partnership where one party brings money and the other party brings expertise. Profits are shared as per an agreed ratio, but if there is a loss, the investor bears the financial loss and the manager loses only their time and effort. In plain terms, if you bring the money, I bring the brains, that kind of a situation is basically Mudarba. So there is an investor, Rabul Mal, who provides the capital. The entrepreneur is called the Mudarib, who manages the project or business. The profits are split in an agreed ratio. If there is a loss, however, the investor loses money. The entrepreneur or Mudarib he only loses his time and effort. He is not liable for monetary loss unless you can prove a misconduct. Okay. Now, how does it work in the real world? An investor provides 1 crore to a startup that delivers halal food logistics. Okay. The entrepreneur runs the business. If the venture earns 20 lakhs in profit and the agreed ratio is 60 to 40, investor gets 12 lakh, manager gets 8 lakh. If it makes a loss, the investor's capital reduces, but the manager is not liable unless negligence can be proven. Okay. That's there's no fixed interest and there are no guaranteed returns in this case. See, you will often find mudarba in Islamic finance, investment funds, and SME financing. It's great for entrepreneurs, who have amazing ideas but who don't necessarily have the capital to execute those. Uh, in a conventional equivalent like angel investors type of situation, the angel investor provides the money. Here the provider is called Rabul Mal. The manager of the entrepreneur is called the Mudarib in the Islamic finance variant. Profit is shared in a pre-agreed ratio. In angel investment, it depends, on the dividend or bonus shares or something like that. The loss is borne by loss is borne by all the participants depending on the agreement. However, here it is only borne by the capital provider. The mudarib has limited liability, that is, the entrepreneur has limited liability, but in case of the conventional equivalent, it may vary by jurisdiction. Again, the same reasons that we saw in earlier instruments, like no guaranteed returns or interest based on risk sharing and trust, real economic activity, not speculative, and both parties must agree clearly on profit ratios upfront. These are the reasons why Mudarba is Sharia compliant. Let's talk about Musharka. What is Musharka? Two or more partners contribute capital to a business or project. They agree upfront in terms of how profits will be shared. But if there is a loss, it is shared according to the proportion of capital contributed. So in this case, both parties have a skin in the game, and it is partnership in the truest sense of the term. Musharka. Okay. Let's say an Islamic bank and a construction company form a musharka to build a residential complex. The bank invests 50 crore, company invests 50 crore. Profits are shared in an agreed ratio that they want 60 is to 40. Whereas if there is a loss, it will be shared 50-50 in the ratio of capital contributed. The difference between Mudarba and Musharka, Mudarba is one person brings capital, the other person brings expertise. In Musharka, both of them bring capital, and Musharka is more of a partnership in the real sense of the term, the way we know it. Again, Malaysia is one of your biggest markets for Islamic finance instruments, something that you can read up later read up on your own later if you wish to develop your understanding of the Islamic finance instruments. So that's pretty much all about Islamic finance. Please make sure that you go through the notes, and these notes will be uploaded in the drive folder. And Islamic finance is often tested for 3 to 4 marks at max in the AFM exam. It's easy if you learn it. I have drawn a lot of parallels with conventional finance also. So work on that properly and make sure that you prepare well for the topic for your AFM exams.